Good morning, traders. Here we are. No, this is not April the 1st, Fool's Day. It's already a week further. We are Monday, 7th of April, and we are going to have a look at what is happening in this wonderful world of finance and tariffs and wars and whatever not. So before going over to the big block, which is obviously the tariffs, just a couple of other lines, really. Just right now, it seems that Ukraine wants to come to an agreement over the minerals deal with the US relatively soon. They are going to prepare and submit a proposal this week to the US. So they are trying to get their act together. Other headlines on the nuclear front. Iran will have a meeting this week in Moscow with China and Russia. And they said that they submitted a proposal to the US, and in their own words, a generous offer to the US, and they are waiting for a response there. So, beside all tariff things, there's still a lot of other geopolitical events going on. Um, for which we have to just bear them in mind. Obviously, the tariffs right now is the biggest thing, and so let's have a look at what happened on Saturday. This first big round of tariffs came into effect. Without wanting to repeat what everybody said, the big picture is that to take Lutnick's word that those tariffs may be in place for at least weeks until negotiations with other countries take place. They said, and Besant also acknowledged that there are more than 50 countries already contacted the US to try to negotiate the tariffs, but so far nothing has been solved by from any side at all. So those tariffs came into effect, and we see the markets react again very heavily today. We see gap opens everywhere on risk. We equity markets are feeling really the heat of all of this. So that is where we stand now. Trump said that the aim of everything is to really eliminate trade deficits, and he was speaking particularly about China, the European Union, and the other side of the those tariffs now, they are really in retaliation mode. We already saw China imposing tariffs on Friday. The EU is preparing. We've got virtually the whole EU political scene talking over the weekend and earlier this morning. I'm just going to go over one or two comments. One is the EU, I think it's like trade commissioner or something like that, Sejourné, who said that they confirmed that the EU's response will be proportionate and unified. He also added that one of the points in the European plan is to, and that would be like really a very hard retaliation, is that they could withdraw all US companies' access from EU markets. That is part of the plan. Also, we know that one part of the plan is to start to slap tariffs or restrictions on digital services, and there we have bit of a different sound from the Irish trade minister, who says that it's highly unlikely the EU will target digital services. So we can see there's still a bit of discord. They all want to be unified in the European Union, but it is not going to be that easy. We've got the impression. So that is something that we are going to have to keep a very close eye on. We know that they are targeting two kind of deadlines for putting in place retaliatory measures. The one is on the 15th of April, and the other one is a bit less clear, but somewhere around the end of April, call it maybe 29th or so of April. but this is something that we really need to pay attention to is how far will they go against those digital services, against those well, the pan US companies really in their retaliation measures. In the meantime, obviously, we are the 7th of April. Sorry, the 15th is next week. That gives them a week of potentially negotiate. The issue is that is where the US stands right now, and that is what spooked the markets again this morning. Is that really Trump and his closest administration really want to do something about trade deficits, and it's not really keeping the tariffs at certain levels so much because they basically want to go in a non-tariff environment. The thing is that from the other side of the coin of those tariffs, there's not only tariffs on U.S. goods. I mean, Europe is imposing VAT on all the kind of goods and services. So I mean, it's not going to be an easy thing to get rid of all those tariffs versus well. Call it tariffs under the global denomination, but it's not going to be easy to get rid of all of those. A lot of those, and well, to start the European Union, but also the individual countries. They count on those VATs and other tariffs to actually stay financially afloat. So I don't think it's going to be very easy to find immediate level playing field or a zero tariff environment. So this thing is probably going to drag on weeks, if not months. Um, uh, and I forgot to mention one thing before I continue on the tariffs. There was a deadline on the TikTok on a TikTok deal or ban that has been pushed back. Kind of expected, I would say, but they gave another 75 days of leeway to find an arrangement over TikTok. So that thing is not really at the forefront. So I thought there may have been something going on between China and the US about it, but that's been now pushed back. So back to the tariffs, and let's go over to Asia. Japan, Ishiba is planning to talk to Trump no later than today. Okay, so they said tonight, which is probably tonight in Japan, so which is probably going to be early US. So keep a very close eye on the events in the Japanese yen. In the meantime, Ishiba has said that he is going to push for an extra budget to counter or to support the Japanese companies which are going to be impacted by those tariffs. So Japan is going to continue with yet another extra budget if they can't find an agreement with the US to completely cancel those tariffs that the US has imposed versus Japan. In China, then, well, as I said, China already imposed some tariffs, and now we heard from the PBOC. They were closed on Friday, so the PBOC fixed the highest dollar yuan fixing since December the 3rd, sorry, of last year, 1980. They are gradually starting to move that fixing higher, which may hint that they could be at the start, is not done yet, but they could potentially be at the start of letting the yuan slip a bit. Not especially to counter the tariffs towards the US, but it does filter through now that they want to send their exports to Europe and other countries as well. So make your currency cheaper so the others can more easily buy your goods. It may also be that within the framework of the Mexican USMCA also they can shift some of those Chinese goods if the yuan is getting cheaper back into the US basically. But what was also very interesting is that they were also hinting at the possibility of lowering interest rates in China. China signaled the readiness to cut interest rates and the RRR again. That is an article that appeared in the People's Daily overnight. So it could be that we're in for rate cuts and a lower yuan. So that is something that for those who trade the Chinese yuan, that we need to keep a very close eye on. I'll put up the Chinese yuan chart a bit later if I don't forget. But basically, the big levels are somewhere between 737 and 738. If that dollar CNH would fly through there, I think it's pretty clear that China is going to let the Chinese yuan weaken a little bit. Um, what else? Besant was out also over the weekend, saying that despite all that's happening now, he doesn't expect a recession in the United States. But as we have seen from Goldman, JP Morgan, they are already starting to price in very high probabilities now of a tariff-induced recession coming in the United States. So they've been flip-flopping, and we all know that if anything happens to cancel or reduce materially those tariffs, they will probably flip-flop again and price out recessions. But for the time being, um, well, basically, all market participants are now ramping up the potential of recessions. And that is where it's going to get interesting as well when we will look at the prices is down to where will central banks allow growth expectations and financial markets to come down before they really want to react. Are we there yet? I wouldn't think so. They are still in a wait and see mode. Perhaps and we will have to make distinction between central banks. Okay, we probably won't have like a global central bank rate cut. Well, I mean, famous last words here. Perhaps tomorrow they all cut rates in unison, but it, it's going to depend down to where and for how long this route is going on. But I suspect that they are getting ready to act if the markets continue to really sharply decline. Putting numbers on it is virtually impossible. I think it's more like time and an amplitude of moves that are going to determine their reaction function rather than actual prices. It's very hard to put a price on things, but I do think that they are in a way getting ready. And we saw Powell talk after the NFP report that we saw on Friday, and well, there's a couple of things about this Powell intervention that we saw. So the one thing is that, and which was kind of striking, is that he still puts as much emphasis on inflation than he puts on growth. Now that they know about those tariffs, he did say that the tariffs were bigger than they were expected. That they also are ready to monitor the financial markets, but he did continue to talk about a potential lasting effect on inflation. So that means that at present time, but we know that things can change very fast. At present time, the balance is pretty even. They are not yet looking rather at growth and the impact on unemployment and the impact on supply chains and the impact on GDP. Basically, it is still even in the balance. I would have thought that after those tariff announcements, they would start to look more at growth than inflation, but they are still on an even basis in the Fed's thinking. The other one, which and we know that people who have been trading markets for a longer time. We know that central banks they are talking, they are very regularly talking, and expect them to talk very regularly right now. Okay, and he also repeated that they were having regular contact with other central banks and communicating to each other what they were hearing in markets. And for the time being, I think they are very loud cries of market participants. By the way, on that note, is that Bill Ackman published a post on X Twitter yesterday urging a 90-day timeout on some of the tariffs because those tariffs were risking, in his words, were an economic nuclear winter and eroding global confidence in the US as a trading partner. So there's a lot of reactions now coming from outside, but also from inside the United States um, to raise the alarm on the harshness of those tariffs and the way that which has already been well documented, the way that they were calculated, not so much on the basis of just tariffs and VAT or so, but just purely on the basis of trading balances. So that is the big thing now, is that Trump and his administration really wants those trading balances to disappear, not just putting an even playing field on some tariffs or VAT or so. So that's where we are now. Let's. I covered everything. Oh no, I had to say something more, and that's on the oil front. We have seen oil really take a dive also at the start of this week. Over the weekend, the Saudis actually slashed their oil price by $2.3 to their major Asian buyers. That will take effect in May, but that's an additional weight on everything that's going on in oil. If it needed already this additional weight around its shoulders, where the market is now trading a global slowdown. We have seen crude oil is dropping now below $60. I'll try to have a look at that as well because those are pretty big moves, obviously. So let's have a quick look at the what came out on the data front. So we had this US jobs report. That combined with Powell not seemingly ready to put the growth risks in front or above the inflation risk is probably the reason why the dollar recovered towards the end of the day on Friday. We had this pretty surprising bigger print in the non-farm payrolls. The private ones are the ones obviously that produce the big number, and but government payrolls still not showing those big cuts. Obviously, what happens next month is anyone's guess. We should start to see those government payrolls starting to drop, but for the time being, that still allowed somewhere Chair Powell and also Trump and his administration in a certain way to hide behind these kind of numbers, okay? And that's we saw the dollar recover a bit towards Friday evening, but and actually it's still trading a bit stronger now, but there are various forces pushing and pulling in the market. So I wouldn't really bank too much on those numbers. The Canadian job reports came out a little bit lower. That's a give back of some more decent reports before that prior one, but it's not great on the full and part-time employment change either. All the jobs and more than on the part-time were lost in the full-time employment change, and that is typically um, not a great feat. And we also saw the participation rate tick slightly lower, and the unemployment rate tick up a little bit. They have been tariffed as well, although under the USMCA rules, they did not get slapped additional tariffs, but we know the relationship between Trump and the Canadian officials. If we get another negative number next month, this could really impact the Canadian dollar still, together with what is going to happen on the tariff front. So that for that, and now we move over to what has happened this morning. Cash earnings in Japan a little bit better. We also heard last week from the Rengo saying that they are relatively positive on the earnings side for the new fiscal year. We should start to get final results out relatively soon. Okay, so that is something that the Bank of Japan is going to take into account. Although we have seen in sympathy with yields dropping very fast everywhere, is that also Japanese yields have been dropping, and the market is really pricing out rate hikes now because of those tariffs, because of the uncertainty surrounding global growth as well. Okay, leading index okay, but those are still February numbers, so a bit outdated already. In the UK, house price is a little lower. The sterling is trading defensive. Let's put it that way. I mean, it's come down. It's come down versus euro, especially as well. It is a risk currency somewhere, despite what Starmer wants to do and get as least tariffs as possible with the US. We may think that the sterling may have been a bit of an outperformer versus the euro, but it's really the risk wrecking ball that is keeping the sterling under the cosh right now. And I'm tempted at times to counter this euro sterling, but I really want to let this risk play or this risk play out completely before making a decision on trading sterling again, because if risk continues to falter, sterling should really still continue to be on the defensive. Okay, we had more February data, but if you look at the IP in Germany in February, it still was more negative than expected, in a nearly complete give back of the numbers that we saw in January, where we were talking about potential green shoots. They have wilted already. So German data still not good in February, and likely they won't be much better after what we know now on the tariffs. And moving straight away to the European Centix investor confidence number for April, that is very big setback as expected, and it won't probably get better for a while. We also had little weaker retail sales than expected, but nothing really that is going to drive the markets right now from the European side. Traditionally, after the NFP data, we have a quiet US session on data front, but we do have the employment trend index out for March, which is going to be a number, obviously, that the market is going to pay attention to. All things employment now could have an impact, even if this data is normally not really a huge one, but this time we need to really pay very close attention to what's happening on the employment side of things, okay, across the globe, but especially what US is concerned, because it is the biggest market. It is the market where people are the most invested. It is the market that is on a big move right now. So those numbers are going to have obviously an impact. Also, and I look at the rest of the data in the sessions to come, but also we cannot forget that we have the start of earnings season for Q1 this week. Just a little thing there. They could still show a very distorted picture, because we know that there has been a lot of front running on potential tariffs to come and stuff like that. So we could see some surprising numbers probably coming out of the earnings season. But what we have to look out for now is what the CEOs, CFOs, CIOs will be saying about the outlook of the future earnings. Okay, I think that's where the market is going to put the biggest emphasis on it right now, is what's going to happen. What are all those companies expecting with their earnings, with their volume numbers? To how will they evolve? What are they expecting? And we may safely say that it's probably not going to be a very rosy picture. But just keep an eye on what the all the CEOs and CFOs are saying about their expectations for their own companies when the numbers and when the results will drop. Right, that's it. Let's look at some prices, okay? And as I said, let's look at what's happening in oil first. We're crashing, not dropping. We're crashing through all the supports. I said that there was a big support zone coming in here, anywhere between 65 and 62 bucks. I even tried it on Friday to see what happens. Um, I knew the risk, but I've kept it to a very small risk. I did buy around that 62 zone, let some go already on the small bounce and got stopped out on the rest. This is still a big fall. It's not been helped by what the Saudis were doing over the weekend. I've got here this zone here now, 61 and a half, 62, and then 63, 63 and a half. Those are the first resistances, okay? And those really need to be retaken for it to just become neutral right now. For the time being, this is looking quite bearish, right? So for as long as we don't recover those levels, there is why not? I mean, when we trade crisis, it's very hard to put like levels in place. You can counter some stuff. There's probably going to be a level here around 57 and a half on oil. It may not go one-way ticket, but we will see what the US wants to do with this. But this picture is not a great one. And Trump said over the weekend as well that he did not on purpose kill all markets, but he said to get better, it may need that we need to take our medicine first. So that is something that the markets will have heard as well. There is no Trump put or Trump call, as Besant called it. If you talk about such kind of instruments like oil or equity markets. So there may be some more medicine taken, and why not? In crisis mode, everything can happen. We lost already 13, 14 bucks in the space of a couple of sessions. Why not another 10 bucks? I wouldn't really rule it out, especially now as well that the Saudis hang another weight around the oil's neck, and Brent is no exception. I did not. Should have put some more things in here, but we are trading. That's what I wanted to show this one. We are trading around the 61.8 here of the whole move from 2020 up to 2022 in Brent. Okay, so we are trading around there. So keep this one in mind. It is 62 and a half bucks. We are just above the 63 line. All right. So let me just put it here to get that number straight. Okay. It's around 62, 60. Call it 62 and a half. Okay. On Brent, for those who are trading Brent, watch that level, I would say. And then while I'm on that chart, gold. I know Derej is always looking at gold. Gold has been pushed and pulled around for two different reasons. Okay, as I said, for quite a while, gold is a hedge against everything that bad that is happening, potential inflation spikes, and then potential growth worries, and then lower interest rates are probably also supporting it. But then the move we saw here, first of all, as I said over the prior meetings, um, there was a risk that we started to at least consolidate, if not retrace, because this 31.5, 32 is a big level for me, a big zone. We started to move to shy away from it. And what happened here is people selling out assets where they are in the money to cover for potential losses that they have in other instruments, and that is what that move that we saw on Friday as well. Okay, so those are different. There are different forces pushing and pulling in gold right now. Can it go lower? Yes, but the interesting thing is that over the overnight, we stopped around the prior wedge support. So that is a little level that we can already now make a note of. 29.70 is something that held, which could already be interesting. Bigger levels will come in around 28.60, and then to me, this level here. If we see more crisis mode trading in those markets, I think this is going to be a level that we need to pay very, very, very close attention to. It's around 2,800. Okay, can we get there? Yes. Will I buy there? Likely, because I still think that gold could be one of the trades for as long as the whole situation is not resolved surrounding trade, okay, and surrounding growth worries. Um, it is still, to me, the trade that people or that I at least want to be in. But we need to also pay attention to headlines, all right? If we get a resolution of this whole thing, we that the reason for the hedge is going to partially at least fall away, okay? And we can have bigger setbacks. Also, bear in mind what China is doing. Overnight, they did not really buy much, but China is potentially planning to cut rates. And we have seen China being a very big part. By the way, the March data showed that PBOC did buy some more gold for the fifth month running. So Asia, in my opinion, will still continue to buy gold. And China, if you talk about rate cuts, do people want to hold um, much else, and they are in the midst of this trade war. I would suspect that Chinese buyers will show up sooner or later. Is it right here? I really don't know, but I think they will show up around here. Be careful if we drop there, because I mean then we could do another like another $200. Okay, so I still think that we are at least trading at very lofty levels, that the whole play to be long gold is not finished, but we need to acknowledge what the pushing and the pulling forces are. Okay, if we are trading more crisis, trading more of this global slowdown, and people need to get out of everything, I mean, we could see some more drops, okay? But I do think that at one stage we will find some support in current situation. That's still how I traded. Silver also saw a big setback. We are trading back around those levels around here. Hang on a minute. We dropped very very sharply. Sorry, to levels to prior lows, December lows, and now we are bouncing. Um, Silver is going to do much better when the situation improves than gold. Okay, silver needs to find a better situation, but on the other side, it's still a metal. Can we drop lower? Yes. If the market continues to trade a crisis, yes, this can still trade lower. A lot of people are looking at 26 and a half to start buying again. I'm not too sure. To me, I think this 28.70 could be enough, unless much more shit hits the fan and we trade much lower down to this 26. Okay, but this is already a pretty decent bounce in silver. So I do suspect, just based on this price action here, that we may find buyers perhaps earlier than this 26 zone. All right. Um, okay, currencies. Let's first see what happened here. So we blew through that trend line last week, but we stopped shy of the trend line resistance here in the 111s, 111.75. That is going to be, I think, the break zone, really, the break zone. Uh, Probably this whole 111.75 up to 112.75. If that goes, then we trade much higher. In the meantime, respect what's going on today. And as a matter of fact, we just tagged this trend line again this morning on the bounce. Okay, let's go in a little shorter term. Oh no, hang on a minute. I stay on the daily. Here, look at where we stopped on the way down. That was earlier in March, okay, but we stopped quite closely to the 200 DMA. Also, in the medium term, this 107.30 or so will probably be a big level that we watch. Now, on the shorter term, there was also something relatively interesting. Okay, we went 10 pips below, and it was the opening of the market. Those levels have to be taken with a pinch of salt, but we stopped relatively close to the 61.8 of this last move from 107.35 up to 111.40s. We stopped around 108.90. I think that's an interesting one for intraday traders to keep an eye on. So for me, the range right now is somewhere 108.90, 110 and a half, and then we are going to have to see if there's more crap hitting what the euro wants to do with it, because we saw the dollar sell-off, but we still can't forget that the euro is being tariffed. Uh, there's the growth in the eurozone was anemic at best. So it is still pushing and pulling with what's going to happen in the eurozone. I don't see too much good news come out if they slap retaliatory measures onto the US. But in on the other hand, once we've seen perhaps this dollar demand on the back of risk or so, I may suspect that we are going to find in current context bids somewhere. Um, I would call it completely off, as I said, if this would go through 107.35, then we're probably going to see a deeper setback. But in the meantime, I'm rather going to look for levels somewhere to hold. But again, when we trade these kind of markets, it is very dangerous to go in like full size positions also, unless you are a high frequency trader and you trade it 10 or 20 pips here and there. But be careful what you do with every position that you put on right now, because the market technicals are just beautiful pictures right now. Okay, but we as traders we like to look at them. So if you want to trade those technical levels, be careful with your stops, be careful with the size of your positions exactly right now. Okay, and then move on to the cable. The cable is, as I said, is not looking as good as others may. We're already below this 128.60 again. I'm I'm not going to trade cable right now, but I would be a bit careful if we start to break below 128.10, 15. Um, and that is basically based on what's happening in risk right now. As I said, sterling is a risk currency. So if we start to break below 128.15, we may see a bit of an acceleration. Why not another big figure lower, somewhere around 127, 127 and a quarter? It's possible to go up. And now we are a bit away. We need to break back above 129 figure a quarter, and then especially 130 figure 40. Then we should go up again. And do we have the strength right now? I'm a little bit doubtful that we find the strength right now, and the reason why is that this euro sterling is holding pretty well right now, and we are actually right now back to this 78.6. and we are comfortably above the trend that we had prior. To really, for me at least, to really start to get more confidence in the sterling again, if you look at this one, 84.70 would be my first signal. If we start to break back and hold below 84.70, that could be a signal that sterling starts to do better again, and that risk in general is actually starting to do better again. But for as long as we are above here, I mean, I'm a bit doubtful to really start to buy sterling. Okay, so that's my thing. Um, Yeah, let's move on to what's happening in the yen. And what's happening in the yen is has been relatively interesting. I said that I had a bit of a target zone around 144 and a half. We really went down there and bounced pretty hard, but then as well, we are um, capped now around 147 figure a quarter. That is really my range. And looking at the volatility, sorry, looking at the volatility that we have in yen right now. I'm not going to look at anything tighter than that because it's too tight in between to start the trading for me. But I think 140, 144 and a half, 147 and a quarter. You go outside, we probably have a bit more moves coming up. Okay, 148.60, 149 and a quarter, possible if we go above there. If we break below 144 and a half, then it's possible that we are going to see with some intermediate stations, right? 143 three quarters, but then that puts those prior lows here. Perhaps back into view, and which are in the 141s. All right. Um, and it'll all depend how risk is trading because we see the I want to yeah, and I'm going to just look at what Diraj was saying or asking about the Kiwi yen. It's not something that I've been really watching, but we've seen the commodity currencies really getting hammered, there is, right? And we saw the Aussie, we saw the Kiwi getting absolutely trounced. Aussie even more than or more so than the Kiwi. So it's no wonder that stuff like the Kiwi yen has been hammered as well. But the interesting thing is that we held around that prior low here at 80.60. So I think that one is your level to the downside, 80.60. All right. And then if you look at in the on the other side, I would say that 82.65, and then a relatively roundish number, 83, 83 figure 15. If you start to get back above there, that should mean that risk is doing better. Okay, and this is really what we trade here, risk. Okay, when you look at the Aussie, been absolutely hammered. When you look at the Aussie and when you look at the Kiwi, they've been trading on the back of risk. Copper also has been sold off very heavily if you look at the Aussie. But the interesting thing here in the Aussie is that we relatively did the whole target for this triangle break on the Aussie, which comes in around somewhere here, and it's also the continuation of a trend line. So 59.40 is my level that I'm watching on the Aussie. If we get back below there, it's going to look very bad. On the other side, 60, 85, 90 is probably where I'll be looking at what the market is doing right now, whether we find sellers around those that prior bottom or not. But if you look at a, a, a real risk trade that has developed is Aussie, all the Aussie crosses, Kiwi, but Kiwi was a bit of a laggard versus the Aussie. But Aussie is really one where you look at how risk is really developing because that had a huge response to what happened in risk, and we see it in all the risk pairs. Call it Aussie yen, Euro Aussie is one um, that really flew away. We are trading about 20 big figures from higher than where we were weeks ago. Let's see this thing. If you look at where we were trading a few weeks ago, um, we are trading around 164, and now a month later we are trading 184. These are big risk moves. Okay, so that is also why I'm saying there is it's not really useful to go and look at too tight um, plays right now because it's really going fast, and you have to take that into account in whatever you are trading. And just to close for today, I'm going to have a look at what's happening on the in the equity markets, because we had a gap open this morning, and we crept through the prior low here, which was just a little retracement before we went higher. But interesting is that we tagged the 48.15, which is the prior high, which is also the 50% of the last move higher that we saw from October 20, the last big move, right? From October 22 up to February, March 2025. That's the 50%. And I think that's interesting enough. So this is your big level for the day or for the days to come. Don't forget we have those earnings as well, right? But this is your big level for the days to come. For as long, and we are actually trying now to start fill those. I don't like to trade gaps, but we are trying to fill those gaps. For as long as we are below 50.35 or so, this is just gap filling, okay? But look at the opening in the US, what they want to do with it, right? For as long as we are below 50.40, 35.40, it is just gap filling, okay? Bigger would be if we start to get back above 51, somewhere towards 51.30, 80 or so. That is going to be a more interesting zone for me to watch. And obviously, this broken trend line, but that comes in quite a bit higher, around 53.5 right now. That is one that is going to be scrutinized by the whole market if we get bigger bounces. All right. Now, what can happen on the downside? Okay, there's a couple of things. If we would break here below 48, 46 and a bit is going to be a level. It's also the 38.2 of the whole pandemic towards the highs. The 38.2 comes in at in the 46s. All right, so that's the next level that's going to be important. But what's really going to be mega important if we crap out here are those levels here, and those come in the 41, 41 and a half zone. We saw low here, we saw prior highs here, prior highs here. We saw deep levels have been showing up here as well. And it is the 50% of the whole move higher, okay? So if the market goes into panic mode, keep a very close eye on what's happening in the 41s, okay? That is going to be mega important to me, right? And finally, Nasdaq, which is also in the focus right now, also opened gap lower, but again, we have tagged some interesting levels here in the 16 and a quarter to 16 and a half zone. So those are that's what I said is an interesting little zone here up to even 16 three quarters, but really 16 and a quarter, 16 and a half is an interesting zone, okay? And that as well, we have to monitor relatively closely. For the time being, we are trying to fill gaps. We are back above the first one, up to 17 and a quarter. That's gap filling, okay? We are trading 16,955 right now. So up to 17 and a quarter gap filling. Can it go above? Obviously, it can go above. But then we're talking about 17,800. If we fill that gap and then the market rallies a bit and we stall here, that to me would still be pretty bearish, okay? So I'm going to keep a relatively close eye on what's happening at 17,800 if ever we get there. And keep, as I said, very close eye on what's happening 16 and a quarter, 16 and a half. If it drops through, even worse, if it drops through on whatever can happen on results, which were pre-tariff results, if it happens over results, then it actually could trigger a bigger move, okay? If it happens over the tariff, then we are still trading the same thing that we are trading right now, which could be the global slowdown, which could be potential tariffs on digitals. But if it happens over pre-tariff results, then I would say pay attention, because this could be then telling us a much bigger move is ongoing. And with that, ladies and gentlemen, I'm going to close the show for today. Thank you very much for being with me. We talk again tomorrow. Safe trading. Don't overdo it. There's always tomorrow, okay? Thank you.